Welcome to this deep dive into the May 2026 Global Market Intelligence Report. Our mission today is to decode this massive tug of war happening right now with your money. The report actually calls it the Stagflationary Peace Trade. Okay, let's unpack this. It's basically like a driver slamming the gas pedal.
And the brakes at the exact same time.
Right, exactly. Like the gas pedal is tech stocks and the brakes are bond yields. You have capital just aggressively rotating into tech equities. I mean, pushing the NASDAQ past 30,000, while the bond market is concurrently driving yields higher. It's a hydraulic system bound to fracture.
Well, what's fascinating here is the massive disconnect we're seeing. On the surface, you have this total market euphoria, right? NASDAQ is up, airlines are surging on supposedly cheaper oil, and the VIX index looks completely calm, sitting down at 16.85.
Which makes it look like smooth sailing.
It does, but it's an illusion. If you look under the hood, institutional smart money is using that low surface volatility to buy panic insurance. This key W index is pegged at 137.39, so they aren't unconcerned. They're actively buying catastrophic insurance at a steep discount.
But wait, I have to push back on that a little. If WTI crude just dropped to $90.65 because the Strait of Hormuz is finally reopening, shouldn't that just kill inflation? I mean, lower input costs usually justify equity optimism.
You'd think so, yeah. But the physical supply chain is actually still totally broken. The strait might be officially open, but shipping traffic is stuck at maybe 10% of pre-war capacity.
Oh, wow. Only 10%?
Yeah, because maritime insurers just refuse to underwrite the holes. And on top of that, Iran is floating this $1 per barrel environmental fee on transit. That acts as a permanent structural tax on global trade.
So the goods just aren't flowing like they used to.
Exactly, regardless of the spot price of crude.
Well, that broken supply chain mechanism totally explains why core PCE is actually reaccelerating to 4.3%.
Yes, sticky inflation.
Right. And that puts the Federal Reserve in an impossible bind. We have the new Fed chair, Kevin Warsh, looking at that sticky 4.3% and favoring strict hawkish rules. But then you have President Trump demanding immediate rate cuts to boom the economy. And, we're just reporting what's in the data here, but that clash is huge.
It creates a paralyzing policy vacuum. When the executive branch and the central bank are engaged in a tug of war over liquidity, capital allocators are forced to just price in maximum monetary uncertainty.
Which naturally leads us to how capital tries to escape that vacuum. Now, here's where it gets really interesting. You'd think Bitcoin steps up as digital gold during a macro panic like this, right?
If we connect this to the bigger picture, it's actually doing the exact opposite.
Yeah.
Crypto is bleeding about $1.47 billion in weekly outflows. It's acting exactly like a risky tech stock right now, not a safe haven.
Wait, really? It's just losing capital?
Yeah, the high rates from that Fed gridlock are totally draining it. Meanwhile, true physical gold is hitting $4,559. It's acting as a real hedge because, well, it doesn't need a constant feed of cheap capital to hold its premium.
Well, there is one weird exception in crypto, right? The Near protocol, which is up 15%.
Right, but that's purely because of its recent AI integration. It has nothing to do with being a currency. It's just riding that exact same AI momentum that's keeping the NASDAQ afloat.
Ah, so it's an AI play. So what does this all mean? When you aggregate all this data for the listener, the market is pricing in this immaculate soft landing.
Yeah, based on AI hype and cheap oil.
Exactly. But the bond market and the physical shipping lanes tell us the true bottom of the inflation cycle hasn't even been reached yet.
This raises an important question. How do you insulate a portfolio when the surface data and the structural reality are so violently out of phase?
Well, I want to leave you with the report's Max Bearish wildcard to mull over. Consider this scenario. What if these Middle East peace talks are actually just a tactical military stall?
Oh, the nightmare scenario. If negotiations collapse and hostilities resume, that energy bottleneck becomes an absolute blockade.
And Brent crude would immediately reprice to, what, $130 a barrel?
Easily. And then Warsh's Fed would be forced into emergency tightening, potentially driving the 10-year Treasury yield up to 5.5%.
Which would seize up the global liquidity engine entirely. So ask yourself, if that sudden central bank-induced stagflationary breakage hits, how protected is your portfolio? Think about that as you review your allocations.